Hi, I'm Kevin Liu. I'm a first year business major concentrating in ITM and minoring in business and computing through the Denning T&M program. So my stock is Oracle. Oracle does things a bit differently. They report their fiscal year ending sometime in May. So currently we're actually on Q2 of 2026, and that's what I'll be explaining with the updates to the model given Q2 updates and current new investments. So a quick overview about what Oracle does. Oracle offers products and services for enterprise information technology, so things like software databases, computing spaces, and digital licensing for a myriad of different technologies such as MySQL. And most recently, they've been investing heavily into the AI infrastructure for making like AI companies clients through providing databases and computing capabilities for these companies. And that's something that we're going to talk about a lot about over in the current key comments from the Q2 earnings report. So a couple of things. First, we'll just talk about revenue in general. It's up a lot. It's up 13% quarterly at around 16.1 billion, which is very substantial. Same with operating income at 6.7 billion, which is up 8% quarterly. So you would imagine the stock price would go up, but in the same quarter, they've also done some incredibly large investments. So they've done their free cash flow is actually a negative 10 billion this quarter, as they've invested a large capex of $12 billion for investments in data centers to better cater towards hosting like cloud software for AI companies. And there's a couple of issues with that. First, having negative cash flow means that their debt is going to rise a lot, and that also means that there's kind of the risk of, given these huge investments in AI computing capabilities, like what happens if they lose to competitors like Amazon, AWS. And that's why if you look at the stock price over the past 3 years, in September it was actually at a peak of around like 300 something dollars. Now it's all the way back up to the pre-rise of 2025, back down to 148. And some other things that Oracle's been doing, they've continued making a marketplace and partner ecosystem through additional partnerships with Broadcom and Palo Alto. And their number one focus in the conference call and writ large the corporation is focusing on AI with new contracts with leading AI clients and like the expansion of cloud that I was mentioning earlier with big capex investments. And there's also a large amount of remaining performance obligations, so like a backlog of revenue that hasn't been recognized yet, of around $4 billion, which contributes to what they project of around $67 billion for revenue year to date in 2026, and that's reflected pretty well in the model. And that's like a quick overview of the earnings report itself. I'll talk about more about the model now. So I'll start with the projections. The revenue is projected to increase by this much based off the new capex investments and based off their own conference call report, where this is about the percent change to around 67 billion. However, that's probably not sustainable because that has like the additional bonus of the 4 billion from unrecognized revenues. And just truthfully, it would be really optimistic to say that they could keep this level of growth up, so I decided to decline it a little bit throughout the years. The operating margin really has been pretty stable. It shouldn't change too much, so it's kept at a constant 31%. Same thing with tax rate. And for the diluted shares, you'll see that the share repurchase rate was basically zero. They have to spend almost all their money on debt repayment once they have the free cash flow once again. You'll see that for the first couple of years, actually, we're still in the state of having a negative free cash flow, resulting in increases to long-term debt, and that eventually be paid back off once we reach 2028, where we can once again start repaying using our cash. The dividend per share growth rate was calculated by just finding the average of the most recent year, that growth, which is around like 6%. That number could be arguably a bit lower, but just like a pretty okay estimate in my opinion. And the historical values were all filled out by Donovan, so I appreciate him for that, given that the 2026 or 2025 year to date results were out in May. Some other stuff, dividends paid should be pretty stable. They have a pretty high commitment to paying those dividends, and that results in kind of the negative cash flow issue I was talking about earlier, which is why their stock is valued pretty low right now. The capex percent is, you'll notice, very high. They have already isolated 12 billion for this quarter alone, and so it wouldn't be wrong to assume that they'd continue to kind of create these huge capex investments, and they that's not sustainable though, so they should eventually teeter back down to kind of where it was before these huge capex investments from 2020 to 2022. And depreciation percentage, I just had to keep it pretty stable as what it is, especially given the new investments. And some other things that changed. So beta has gone higher from what it used to be last quarter. These were updated, but yeah, those are basically given to us. Our PE is about 28, which is also down a lot compared to what Donovan had for last quarter, as the market price has obviously come down quite substantially in the past couple months, as between Q1 and Q2. And so we have an intrinsic value, a final one of 169.31, which is a small upside. So my overall take on the stock is that it's a tad bit risky given the kind of reliance on the fact that Oracle needs to beat out other cloud computing software providers like Amazon that I mentioned earlier, and it also relies heavily on kind of the AI bubble continuing to, or the AI industry continuing to grow rapidly to as their main clientele for all these huge capex investments to pay off with a positive ROI. So I would kind of just give it like an intermediate scale. It's not a bad investment. It's not a great one either. There's a potential for a small amount of upside, but it is pretty risky. So it's based off what you would think of Oracle's performance and Oracle's technological offerings. Some other things have changed. The market cap has basically halved from whenever Donovan last updated it. The forward PE is also down a lot from what it historically has been. It's historically been quite high, actually. Almost, I think, peaks at 40, and we're down to 18.66 for the future. Currently, it's around 28. The dividend yield also went up a bit, which is good, I guess. And beta has increased, as I mentioned earlier. The week range hasn't changed much, but that makes sense, given it basically went up and back down. And yeah. Thank you.